and that has dictated in part what our stock of the day is, although I must say this is the biggest percentage mover on the 200 today, and that is Reece, REH. So it saw its first half net profit fall 20% on the back of subdued housing markets in Australia, New Zealand, and the US, which has really dampened demand for the plumbing and bathroom supplies group. However, management says there are signs of a gradual recovery emerging in ANZ, with Morgans adding the results were better than expected. Net profit coming in at $144 million for the half. Sales revenue rising 6% to $4.65 billion on earnings down 6%. Reece says it's cautious on the pace of the recovery and that it doesn't expect a material shift in demand for the rest of FY26. It's guiding to full year EBIT of between $520 and $540 million. Shareholders will receive a fully franked interim dividend of 5.44 cents per share. Well, guess what? Ray Chan from Morgans is here. So Raymond, what do you make of our stock of the day? Buy, hold, or sell?
We have a whole recommendation. Our analysts think, the Australian and New Zealand business certainly doing better than market expected. The US continue to be a drag because of the affordability, because of the low residential construction activities over there. Reece is a high quality company, founder-led business, but at this current price, we continue to have a whole recommendation. But got to admit, today's result beat market expectation, and also the company took the opportunity to slightly upgrade the market guidance as well. So that's certainly welcome. In otherwise pretty red market today.
Yeah, thanks. So Reece, it has been so troubled, has such a disappointing outcome for many shareholders because it was one of those high flyers, went overseas, it appeared that it was all going wrong. So is they back on track?
I think it's a great company. That move overseas, Australian companies have such a bad track record, and it's got nothing to do with Reece. It's just hard. And I guess our business cycle is quite unique in the construction side of things. There's no surprise that the local business, especially in the construction cycle, looks pretty decent. We're talking about government just handed out 5% deposit, first home buyer. So in that theory, yes, it jumped up, and then the RBA came and hiked, which probably smacked it. So I think the construction optimism is probably in the local market is a bit overpriced. US, obvious reasons, borrowing costs are high, and that slowed down, and the cost of construction is going through the roof. You think of any commodity that's used in construction, steel, copper, whatever you want to think of, they're all going through the roof. So, and that's going to hit them. So now they're trying to, they get into a position where they're, as one of my contacts said this morning, they're trying to be the Bunnings. And the problem is, Masters learned a long time ago, it's hard to be competing with Bunnings. It's a tough cycle. I think it is a great business, but it's in the wrong cycle. So it's going to struggle. It's up a lot today. I suspect that's mainly because it's about 3.2% short, and the shorts were hoping that the result would look diabolical, and it wasn't, so you're getting a bounce. These are cyclical stocks. So you're betting on a cyclical recovery cycle. I don't think we've bottomed out in this cycle yet. So I don't think you need to pick it. I wouldn't put fresh money in it, but if you're there, I think it's okay to hold. You just have to understand that it'll take a bit of time before the cycle kicks in and the recovery comes through. It's a good business. It's a classic cyclical, but the cycle is going to probably have more downside risk in the short term. But it's one of those companies, if you're there, you've taken, look, you're down nearly 50%. So you can take a bit of hit and you can wait for the recovery cycle, but fresh money, I wouldn't put it in.
Okay, thank you. So that's a hold for our stock of the day, which is Reece.